So the most common question I get as a retirement advisor is, can I retire today? And you can use a complex software to figure the answer, but I'm going to show you guys a way to loosely figure out how close you are to retirement, and if you can't retire today, how long it's going to take before you can. So let's jump to it. So whether or not you can retire today is based on a very simple formula, and that is your monthly income, less taxes, less your monthly retirement expenses. And if there's a shortfall, figuring out whether or not you've got enough in your retirement savings to cover that shortfall for the rest of your life. So let's walk through an example of what that might look like for your average retiree. So say we've got just an individual, I think that'll make it easy, who has a Social Security benefit, and that's equal to, let's just say, $1,500 per month. So maybe they're taking early at 62, so their benefit's a little smaller than if they were to wait until their full retirement age. We're also going to assume that this individual has a pension, and we'll say that that pension is equal to $2,000 a month. $2,000. Now what we need to figure out is how much that is total, and then the amount of tax, just an average tax rate to apply to that total. So we'll say the total down here between those two is pretty straightforward. It looks like $3,500. I just got to get faster at drawing here. And so we've got $3,500 monthly total. And I'm going to assume, not assume actually, I did taxes for 10 years and I've run hundreds of retirement plans, and I've noticed that the average retiree will pay anywhere from 12 to 15% in federal tax and about 5% in state tax. Now, if you continue working, that would be different because you have to continue paying FICA. And FICA is split between Social Security and Medicare. It's about 7.65% per year on your earnings. So we're going to assume that this person has retired. They've walked away from the workforce and they don't have to deal with that 7.65%. So we're going to give them the high side on the federal of 15%, and then we'll go with 5% from state. So that'll be a total 20% on the year. So now what we'll do is open a calculator, and we'll get kind of a post-tax monthly income figure. So it'll be 3,500 times 0.8. So for you, once you figure out what your total monthly income is, Social Security and pension if you have it, if you got rental income, you can add that, any type of income, royalty income, whatever. Add it all together and then multiply that by 80%. And that equals $2,800 for this individual. So after tax, we are left with, so we'll just say, I don't want to spell this whole thing, but let's see, after tax, we are left with, I should have just said net there. That would have been easier. I have to be selective. And we'll say 2,800. Okay. So let's also assume that this individual has retirement expenses and that those expenses are greater than their retirement income. So we'll say that we're going to shorten this up. We're going to use EXP, and we'll say that that is equal to, let's go $4,000 a month. Okay, $4,000 a month, and that's not unheard of, especially nowadays with the cost of goods and services having risen so high via inflation. $4,000 per month. So what you need to do is figure the difference between how much income you receive after you pay tax and your monthly expenses. So if we do a little math here, income less your expenses, that is going to give us a number. And I'll pull up the calculator to make it easy for myself. 2,800 minus 4,000. It's a $1,200, and I should put a negative right out there in front, negative $1,200 per month. Okay, so we have to figure out how much we need to have saved in order to cover this shortfall, this monthly negative net cash flow in over a 12-month period. Really, it's $1,200 monthly, but it's much higher if you think annually. for the next 25 or 30 years, right? So let's do something here. First of all, let's take this by 12, and that way we know how much the shortfall is annually. So it's 1,200, and we'll use our calculator once again, 1,200 times 12, and they're short every month. I'm gonna put a big figure down here, woo, and we'll do less, and we've got 14,400. 14,400 per year. So the question then becomes, how much do we need to produce on our retirement savings in order to live off the interest? So I'm going to share with you guys what is known as the 4% rule. And we're going to look it up by definition, and then I'll explain it. All right, so I went over to Google and I just typed in the 4% rule, and I'm going to read you guys this one little definition here. So it's the 4% rule for retirement is a guideline that suggests withdrawing 4% of your savings each year in order to have a 95% chance of not running out of money. This amount is adjusted for inflation, so you can live comfortably in retirement without fear of outliving your money. This rule can help you determine how long your money will last in retirement and whether or not you need to adjust your spending. Now I'm going to jump over and into another article on the Forbes website that's a little bit more technical, but it'll help us better understand this 4% rule because it is important for you retirees or potential retirees. So I'm going to kind of move down here, and it tells us about how it works. So the 4% rule is easy to follow. In the first year retirement, you can withdraw 4%, up to 4% of your portfolio's value. If you have saved $1 million, for example, you could spend $40,000 in the first year of retirement. Beginning in year 2, you adjust this amount by the rate of inflation. If inflation were 2%, for example, you could withdraw a $40,800 or 1.02%, $40,000 times 1.02%. In the rare case where prices went down by 2%, you would withdraw less than you did the previous year, $39,200 in our example. In year 3, you take the prior year's allowed withdrawal and then adjust the amount for the amount of inflation. So now that we have a basic understanding of the 4% rule, that whatever we have in retirement savings, if we multiply that by 4%, we can take that to supplement our retirement income sources such as Social Security and pension. Now, another good thing we know about the 4% rule is that we can increase it every year to offset the rising cost of goods and services. And we should still have enough throughout retirement in order to avoid running out of money. Now, another cool feature of the 4% rule is that we can use it to figure out how much we need to have saved from a shortfall. So in this instance, we know that we're short $14,400 every year. So if I were to take that $14,400, and I'm going to go ahead and bring it up here to the top right of the screen, and instead I divide it, instead of multiply, by 4%, then we would know how much this person would need saved in order to retire. So let's pull up a calculator, and we will take the $14,400 and we will divide that by 0.04, and this individual would need to have saved $360,000 in order or before they could retire. So you can do the same exact thing. Figure out what your pension, Social Security, or any other retirement income you're going to collect is. Reduce that by 20%, so multiply it by 80%, and then subtract your expenses from that income. If there's a negative, if it produces a negative monthly cash flow, then just take that and divide it by the 4% rule and compare that number right there to how much you actually have saved. So if you do the exercise for yourself, you'll land in one of two places. First, you'll have this amount or more. Then what you'll want to do is work with an advisor to help structure that portfolio in a way that's designed to meet those 4% rule standards. You can reach out to us. I'm a retirement advisor. You could reach out to your advisor. Second, for those of you who do not have enough, the next question that normally comes up is, how much do I need to save, say monthly, at what percentage in order to reach that goal. I'm going to use an example. We're going to delete this stuff here. And then what I'm going to do is just kind of pull this $360,000 up here because we know that that's our goal. Oop, we forgot one of our O's, or zeros. And I'm going to assume we've got a 50-year-old, right? Age 50. And they've got a retirement age, we'll say, of 62. And currently they've got saved, let's say, $250,000. So the question is, how much would they have to save every month, given some rate of return, we'll say the market's average here in a minute, in order to reach the $260,000? Now, what I normally do for that is I use a compounding interest calculator. So let me open up another tab here. Compounding interest calculator. And there is a way to figure this out with like a advanced calculator, but I'll show you an easy way to do it. It's a little bit of work, but here we'll say we've got our initial investment. Now we know that client has $250,000, so you put your current balance in there. Now the monthly contribution we'll leave blank just for a moment, and then we'll say length of time. Well, if looking back, they are 50, they're going to retire 62, they've got 12 years. That we call your time horizon. So we'll put 12 in there. And then we've got an estimated interest rate, okay? The market averages in like a moderate portfolio, moderate aggressive nowadays because bonds and bond rates are down, fixed income rates are down. But anyways, we'll go with 7% for now. And that's pre-retiree. Post-retiree, when you retire, this is going to be between 4 and 6%. So it'll be much lower. When you're working, it's usually between 6 and 8%. So 7% is the average. Now, what we'll do is we'll just set that to annually for now. We're trying to get a loose number here, or idea of what we could expect to have if we don't make any more contributions to the investment, if we just let it sit for the next 12 years earning 7% per year compounding interest. And if you look down here by the 12th year, they're anticipating that this client would have $563,000. So if we look back and we compare the $560,000 balance to the 360, right? This is telling us that they would have, and this is not a great example because the example we want, they would be short, but that's okay. They would be short, but that's okay. So 563 we'll say. And that example, they have 563,000. Okay, so they've made it, and that's based on 7% current balance over 10 years. So I'll put that down here. That was 7, and we're going to say TH for time horizon, and that is equal to 12 years. Okay, so 12 years. So we know this individual could get there. But let's assume they have less, right? Let's assume instead they're starting with, I don't know, let's say $100,000 and they only have the same 12 years to get there. If we put the $100,000 in the calculator, do they get to the 360? Well, let's find out. We go back to our calculator and we plug in $100,000, say 12 years at the same 7%, and we hit calculate. Now it's 225. So the question is, how much would they need to save in order to get to 360 monthly? So an easy way to do this, it's tedious, but it's easy, is you'll just go back up to the monthly contributions and just start with like $500 per month, right? That's $6,000 a year. If I hit calculate, what does it get? Where does it get us? 332. So we're pretty close to the 360. Let's up it by, I don't know, $50 should probably get us there. And we'll hit calculate, and that's 343. So 600 is probably a closer guess. And we'll try 600, and that brings us to 354. I mean, we're right within range. So $700 would definitely get us there. So if they're doing $700 a month into their IRA or 401k, they get to 375. So between $650 and $700 a month, in addition to what that they have, which is the $100,000 for the next 12 years, they'd be able to satisfy that $360,000 goal. So in this case, they'd have to do the same 7%, right? So we could actually just kind of use this, bring this down, so we know that it'll apply, and we'll just say plus they need to be doing 650 $650 to $700, and that's going to be monthly. And we'll put a $sign here so you don't think this is your FICO score. And there it is. So that's a significant contribution, but for a lot of people, this is what they're deferring to their 401ks. You're talking 5-6% of your annual salary. Even for a person that's making a household that's making $100,000 per year, you're talking about at 6% or so. That's $6,000 divided by 12. That's $500 a month. So that would almost get this person there. And there you go. So you could do the same thing with your numbers. So hopefully you guys got a pretty good idea as to how you can estimate whether or not you have enough saved today in order to retire. There are a lot of other considerations. For those of you that have enough to retire today, you're going to want to work with an advisor to set up a portfolio that meets those 4% rule kind of standards, those requirements. For those of you that don't have enough, you're going to want to sit down and build a plan on how you can achieve that goal. The loose math here today is just kind of a check-in, a barometer to figure whether or not you're even close. But if you're pretty far out, it's time to get serious, sit down and get a plan together to figure out what you can set aside. Your risk tolerance is going to be a big factor here, because how much you can afford to risk is going to determine that rate of return. And the higher that rate of return is, the less it's going to take from you monthly in order to achieve your goal. So anyways, if you guys need help, if you're looking for a financial advisor, I run an RIA, a registered investment advisory firm in Newport Beach, California. I take appointments by call or in person. However, it doesn't matter, but I can help you put together a plan in order to overcome the kind of the challenges of retirement and building that portfolio when you do have enough, or putting together a plan to help you accumulate enough in order to retire. So again, thanks so much for tuning in, and definitely, thanks so much for tuning in, and hope to see you guys in the next video.